Hello traders, and welcome to my third chart pattern video. So in today's video, as you can see, we'll be talking about bearish and bullish wedges. And the reason I want to talk about these is because these are very common in the market, probably one of the most common chart patterns ever. All a wedge really is a period against the overlying trend that does not have a lot of momentum and does not have a lot of volume. So if we look here in our first example, we see that we're in a strong bear market. Price is going down very quickly. And when price goes down very, very quickly, you reach a point of being oversold. After you reach this point of being oversold, you get a slightly sideways upward market of where demand is beginning to pick up, but not enough to cause an uptrend. And that's what you see here. You see price rise with a lot of retracement, attempt to rise more, a lot of retracement, then price begins to not move as much before a breakout continues the trend. And you see this here in the bullish wedge as well, where we have lowering momentum and lowering volume until we get a breakout. Now the key factors in a rising and a falling wedge is what you see is in a rising wedge, you see support going higher, but then you see resistance not going as high. And basically what does this mean? This means that price is really unable to make new highs, but is very able to heighten its lows, if that makes sense. And if we see here, price is really unable to make lower lows. It's really struggling to make lower lows, but lower highs are occurring, which could be very bullish in this consolidation period. And then, of course, what you see is then the breakout. So why do these form? What's the underlying reason? The reason that these form is, if we look here, after we get to an overbought point, many traders are going to be taking profits in this period. And this could manifest itself in this way, where you see demand begin to pick up here, but then demand stops being picked up. You see, again, that happens. And the reason why this part begins to lower is because many traders who had bought here and targeted levels of resistance here are not able to sell, and then when price comes up to here and hits many lower sell orders that they had around at the previous peak, you see many traders who are front running each other, meaning that they're trying to sell before other traders sell, which will mean that we'll get a lower high. And that happens again here as we get traders attempting to target this level, but they can't, which pushes us down to here, as this is the highest level that you can really sell at. And then after this happens, you get a breakout where as momentum and volume wanes, any sudden move in the market when momentum and volume are falling is going to be very, very strong. Because a period of inactivity is always followed by a period of high activity, and vice versa too. You can see that this is the period of high activity, and this is the period of low activity. Low activity here. Very high bullish activity, and then we get very small activity, which has to turn eventually into very high momentum and very high volume. So let's look at two examples of a rising wedge and one example of a falling wedge. So what we see here is a classic rising wedge. And remember, a rising wedge is bearish. A falling wedge is bullish. So we could see the exact categorization here on the 1 hour for Bitcoin, where we have a period of heightening support, but we can see that price is struggling to make new highs, as you can see here. And momentum is really not that high in the bullish direction. It's definitely higher in the bearish direction, as you can see, with this evening star and this bearish engulf. But the most important part of a wedge formation is this, the volume. If I'm just going to draw a line of best fit down to the end of this wedge, we can see that volume really is falling and not doing too well. And if I was to, this line's going to move, as you can see there. But if I was to show you guys this, you can see that this is very high bearish volume, very energetic volume down to here until we get to that oversold point that I was talking about. And at that oversold point, volume begins to fall off as price goes higher. And what's interesting is then you can see this right here is our period of wedge. But right here, after the wedge fails, after price fails to make any higher highs, volume picks up like right again, just like that, with a very strong movement to the downside. And as it began here. So really this is all the hallmarks of a perfect falling wedge, perfect rising wedge, pardon me. You have a high period of very strong momentum, very strong bearish volume. You can absolutely see it here. And then we have that period of inactivity as price goes upward. The wedge is important, but really in any market where you see a strong bear market like this, rapidly falling on great volume, and you see any kind of sideways or slightly bullish movement, and you do not see a lot of volume, you see volume falling like this, that's a really bad sign for the bulls. That shows that demand is not outpacing supply, and that demand is falling like this, which would mean that price eventually is going to fall like this. So this is a really good example of seeing that. And let's just take a look at that breakout candle that we got, which was right here. These two candles on the hourly broke us out of this wedge and took us much lower. So if you were in the market and you were a savvy chartist, then you would identify this as a rising wedge, and then once you saw a breakout, you'd either want to sell your asset or short your asset. So if I was in this market, I would probably want to short anywhere in this range right here. This is a beautiful spot to open a short with fantastic risk reward of a stop loss around the midpoint of your wedge. And again, just like any chart pattern, most patterns will tell you that your target area, just as like a standard fantastic target area, is going to be the range of the wedge. If you saw my second video, you'd understand what I'm talking about here. You do the max minus the low, and then you subtract that from the low here. So this looks to be around 4K, and the high looks to be around 43.80 just about. So that would be a 380 difference. So all we would really want to target for just a simple take profit would be 380, this point minus 380. So 4K minus 380 is 3620, I believe, by my math. And we can see that that point would have been reached around here-ish. Again, that's just like an arbitrary way to take profits, because typically that's what you see, where max minus min for any trading, any chart pattern is a great way to get a initial take profit. Okay, so that was our first rising wedge. Now, when I show you guys the second rising wedge, I want you to identify with yourself the features that this wedge accompanies before I explain it. So we have one right here, and I'm going to pause this video. I'm just going to let this video sit for about 5 seconds. You can pause the video if you like, but just try to look at what's going on in the market before I explain it. All right, I hope you answered. So what's happening in this market? The first thing that I see is very strong bearish movement. Before we even get this rising wedge, this is a very strong bearish engulfing continuation pattern, as you can see downward. And here's the volume. And here's the, it went down from 4,400 all the way down to 4,300, so very big. And then we get this pattern right here. And this is even more textbook rising wedge right here. We can see that after this strong bearish movement, price has to recover. And as price is moving upward and struggling to make higher highs, look at volume. Volume has completely fallen off to the wayside. And the really interesting thing about this is that when volume gets to its very tiniest, which is right around down here, this is exactly when the breakout occurs right here. So again, if you were in this market, if you had bought anywhere here and you were looking to get out of this market, a fantastic place to get out would be when volume is just getting tiny, because you know that if price has strong volume supported movement to the downside and then very, very weak volume neglected movement to the upside, odds are price is going to continue going down. And you see that right here. If you hadn't gotten out around this area, you would have to get out around here. These two strong bearish candles with supported volume that's actually getting higher, that really looks terrible. So yeah, this is another pattern. Again, if you would like to, you could just calculate the max to low, which is the 42.20, to the around 43.40, so that's around 120. So then you do this minus 120, which would be around 4,100. So that would put you down to around here for your target take profit if you had shorted this market. So yeah, we've gone over the rising wedge, which is a bearish pattern. I've talked a lot about volume and previous context in the market, and then also what will happen after the breakout occurs. We've also talked about take profits and target points, with the best target points usually being the 1-to-1 of the chart pattern to the lay side, to the downside. And yeah, now let's look at one example of a falling wedge, which is a bullish pattern. So again, this is another just textbook falling wedge we have here. And I'll give you guys again another 5 seconds. At this point, you should be able to identify volume, previous price context, and post chart pattern context too. The breakout candles and targets where you'd want to take profit. Give you guys 5 seconds. Okay, so what we see in this market is, again, very strong bullish movement before this chart pattern occurs. Right here, it's volume supported. It looks to be a reversal as well because we had price going down. This looks to be very bullish. And now we have just the classic falling wedge that this one's pretty obvious. And if I had seen this in the market, then I would have no trouble putting a buy order around these levels. And what we see again is support is not really falling too quickly, but resistance is falling a little quicker, which is fantastic for a falling wedge. And again, we can see, I will draw it, but we can see that volume is falling from the apex, from the origin, excuse me, as you can see right here. Another way to draw it would just be, if I was to draw it from really another beginning of it, it'd be probably around here. Either way, you can see the volume is falling. Even if I drew it from here down to here, or here down to here, we can see that bearish volume really isn't that high. And also, this is probably a Fibonacci retracement, this line right here. And then the breakout here is not as obvious, the continuation pattern with this bullish market. The strongest indicator, I would say, the strongest two would probably be this one right here. This is a very strong bullish candle. Even though it does have a higher wick, it still is very strong as a breakout candle, and fantastic volume. Another obvious one would be this guy right here. We can see that this breaks the trend line. And breakouts are candlesticks that break the trend line. So it's really important to identify if you're in a wedge, a rising or falling wedge, and you want to draw a line so that you can get an alert if price does break the trend line. And then you can act from there on what you want to do with the market. So this one looks like another great point. It has higher than average moving average volume, as you can see right here, and it does propel price upward. And that's going to be it for this video. We could see, and well, one last thing, you could also calculate range from this is Ethereum 213 down to around 188. The math on that's probably, is that like 25? 213. Yeah, that's 20. That's 25. So then you would just add 25 from here. To 213 plus 25 is 228, 238. Which almost was hit around here. So around here would be your profit target. Yeah, so that's going to be it for this video. We've gone over rising and falling wedges in both bullish and bearish markets. Key things to remember is volume. You need to see with both of these patterns, you need to see falling volume. And if you see very high volume spikes and very high volume patterns, then you're probably not looking at a wedge. You're probably looking at the beginning of a full-on reversal. So that's going to be it for this video. If you have any questions on chart patterns or any concerns or any ideas for future videos with chart patterns, then feel free to leave them in the comments. Thanks for watching.